Hey everyone, Steve Penn here. Today is Sunday, August 9th, 2026 with your weekend silver charts report and video. This video is going to be a little bit shorter than normal, probably about 15 to 20 minutes, but we did have an exciting week and we got a lot to discuss. I'm going to start off with some actionable takeaways, but first, always remember you're trading investing at your own risk. Never take anything I say as advice. I have to say that, really do mean it. All right, let's start off here with some actionable takeaways. As you guys know, I've had a very cautious tone since we took life-changing profits back in late January when silver got to 120, gold 5,600, uranium got over $100 a pound. Well, we've been very cautious, and rightfully so, and it's worked out really well. You know, there's a lot of people who are just kind of, they always want to tell you silver and gold are going to go up. Like, I think we've taken a very kind of responsible tone here the last 6-7 months. But I do now have the highest level of conviction since that January peak that the lows are in. Now, of course, that doesn't mean it's guaranteed. I'm assigning an admittedly subjective 80% probability that the lows are now in. That means there's a 20% chance I'm dead wrong and we go right back down lower. That's always possible. Nothing's guaranteed. However, we are getting a bit short-term overbought here in silver, uranium, gold, and platinum. So I wouldn't be surprised to see one more dip, not lower lows, but a dip to maybe it's common to retrace half of a move. So like this last week, we had a really big move up. So if we pull back and retrace half of this last week's move, that could be a spot to kind of top off your positions if you're looking to do so before this uptrend resumes. So that's exactly what I'm looking to do. If we pull back and retrace about half of this last week's gains, I'm looking to add Cameco, Sprott Physical Uranium Trust, GDX, Royal Gold, and Wheaton Precious Metals. I really want to get to 100 shares of Cameco, Royal Gold, Wheaton Precious, and GDX before our sectors kind of start moving higher again while we're still down in this accumulation zone. And the reason I want 100 shares is so I can sell covered calls against my core positions. And just a quick note on covered calls, it's a relatively lower risk trading strategy that has the potential to boost your returns by about 2% a month. That's a nice target, boosting your returns by about 2%, which can really compound over time. It's over 25% a year if you trade that successfully. And we've got a track record of doing just that in a system that allows us to profit in a highly consistent way. And I mention that because I know a lot of people are into penny stocks, and nothing wrong with that. I don't like penny stocks. I don't like explorers and developers. I think that excessive risk is not more than offsets the potential upside. Where if I want to boost my returns by taking on a little bit extra risk, I'd much prefer to sell covered calls on like profitable companies, Royal Gold, Wheaton Precious Metals, companies that are just swimming in cash, Cameco, that are just printing money, and I can add a little bit of leverage with covered calls. So anyway, that's my plan for the week. If energy, I didn't put anything in here about energy, but if energy, if oil, let's just call it, if West Texas Intermediate dips down towards the low 70s, high 60s, well, that's where I plan to accumulate stock shares of Chevron, ExxonMobil, and or XLE. And conversely, if we run back up towards that 120 peak, well, that's where I'm going to trim profits and or sell covered calls on those core positions. So I forgot to mention that. Now, I do want to make a key distinction between my intermediate term outlook and my long-term outlook, specifically regarding precious metals, but these comments apply to uranium as well. I think of this as like pre-bust versus post-bust, pre-deflationary impulse versus post-deflationary impulse. If you've been around here for any length of time, you know that I believe it will be the Fed's response to the next big deflationary impulse that is the catalyst that sends our focus sectors to the targets we've all been waiting for: $300 plus silver, 10,000 plus gold, 150 plus uranium. Now, before that, I do expect before the next bust, the next deflationary impulse, the next market crash, the next panic, whatever you want to call it. Before that, I think there's a high probability that we at least run up towards the previous all-time highs in each of our focus sectors. So with uranium, that would be about $147. In silver, of course, that's $120. In gold, that's of course $5,600. And in platinum, that's just north of $3,000. So I expect that to happen before the next bust. Now, when that next deflationary impulse happens, well, I think everything gets kind of crushed again, and silver probably back test 50 another time, yet again. So my point is, if things play out according to my roadmap, which you should always take with a grain of salt, everyone has a forecast and a roadmap. Very few people actually are consistently accurate. In fact, I don't know of anyone who's able to kind of have a forecast with that level of precision. So it's important to have a forecast, but it's also important to adapt as new information comes in and not be married to it. Everyone's got a thesis, and only one person can be right. So this is my operating roadmap. If we run up towards the previous all-time highs in each of our focus sectors, my plan is to trim profits and sell covered calls aggressively. And then my plan is on the next panic-driven sell-off, I'm going to load back up and then hold on for those ultimate targets we've all been waiting for: 300 plus silver, 10,000 plus gold, and 150 plus uranium. So hopefully that helps. Let me start over here with the website. I want to open up silvercharts.com and briefly talk about a couple of things, a couple of housekeeping notes. We're doing a live stream, my personal financial freedom framework. That's on August 19th. I'm putting a lot of work into that. So you'll see a link right before I go live to join. And I'm just going to walk you through my entire financial plan, some tax mitigation strategies, and how I think about my whole financial plan from a broader perspective than just what you see on silver charts. And I think that'll provide some nice context and hopefully give people some ideas to improve their own financial plan. We'll be talking about those kind of things and much more at a live event that we're doing in Franklin, Tennessee, just south of Nashville. Chris and Brett Botcher, they're doctors of physical therapy. They left conventional healthcare to really help people with more like one-on-one coaching and pursuing what you guys have met them before, so I don't need to introduce you, but they asked me if I would do this live event with them, and the answer was yes before they even finished asking the question. So I'm really excited. It's going to be just 30 people. We're not trying to like make money on this or anything. But there's a cost to it because we're going to have meals, we're going to rent out a venue and all this. But so it's $1,000, and there's going to be 30 people, 30 total, and we're just going to take the weekend. We're going to go on a hike. We're going to have some presentations on fitness, on health, and on generating income in retirement. So look forward to seeing a few of you guys out there in person for that. All right, let's go ahead and take a look at some of the COTs and we'll look at charts. So gold, really not much to say as far as the COT, same for silver and platinum, but we'll look at them nonetheless. You can see these blue bars at the bottom represent the commercial net short position. So we really don't want to see these bars getting longer because that tells you what the commercial's doing while they're shorting. And that's typically what they do. I call it watch, rinse, repeat cycle. They short into rallies in silver, gold, and platinum. And that's exactly what happened last week. Now, it wasn't a big increase. Now remember, this data is captured on Tuesday. So if we had Wednesday, Thursday, Friday's data, which were the really big moves, well, you would expect for this bar to be a lot longer. So probably is. So they're shorting into strength. It's not really what we want to see, but it's what they tend to always do. And you can see the same thing. Silver, slight increase in that commercial net short position. Same thing in platinum. A little bit of a bigger increase in that commercial net short position in platinum. All right, so let's go ahead and switch gears and let's go through some charts. And I gotta find my charts. There we go. 10-year. I'm watching this very closely about this 5.5% level. I think is the key level to watch. This 5.5% yield on the 10-year. I believe that the 40+ year bull market in bonds broke. It came to an end in March of 2020 during COVID when the yield got down to 0.4%, intraday got down to 0.3%. That is ridiculous, especially when we're talking about a country that is the most indebted empire that's ever existed. So interest rates should reflect that level of credit risk. So in other words, interest rates should be higher. Well, being 0.4% is ridiculous. So I believe that marked the end of this bubble, and I expect rates to trend higher over time. That doesn't mean they can't come lower, short term. We're going to get short term overbought from time to time. But I think over the long term, rates are going to trend higher. Now this is especially important. This is the most important chart to watch, I think, over the long term, because every 1% rise in interest rates on a $40 trillion national debt is what's that, $400 billion in interest expense that the government has to come up with when they collect just over $5 trillion in federal tax receipts. So if this is truly going to move higher, if interest rates are going to move higher, well, picture if it goes to 10%, which isn't even to where it got in 1980. Well, 10% on $40 trillion is $4 trillion in interest expense. We're headed to a point, if this continues to move higher, where 100% of tax receipts go towards simply servicing interest on the debt. Think about that. We're headed to a point at some point when all of our tax dollars, 100% of them, go just towards interest on the debt. Obviously, something will break before that, and there'll be some kind of new system before that. And I look at physical silver, physical gold as a bridge to get from one system to the next. It's coming. It's just a matter of when. And the biggest variable in the equation of when this happens is interest rates. So we watch that very closely. So didn't mean to talk too long about that. Gold silver ratio moved in favor of silver this past week. Silver outperformed gold by about 2.5%. We're at 69 to 1 level on the gold silver ratio. The key number to keep in mind is 43 to 1. Anything below 43 to 1, we're in kind of rare territory, and that's where it's a good spot to consider swapping some silver for gold. Couple of ratio charts here. I always like to watch the median U.S. home price in ounces of gold. And last week we got to north of 100. Well, we're back down to 94 to 1. Houses just got 7% cheaper, 6.9 to be exact, when priced in gold. When you price things in dollars, there's all kinds of distortions. But when you price things in gold, real money, you get a more accurate reflection of the true price of things, I guess is what I'm trying to say. And I like to price things in gold as opposed to the dollar, which is an ever-changing unit of account. Well, homes just got 6% cheaper, 7% cheaper last week when priced in gold. When priced in silver, they got even more cheap, 9.2% cheaper when priced in silver. You can now swap 6,470 ounces for the median priced home in the United States. We got down to 3,300 in January, and the all-time low here is 1327. I think we're going to see this point again, if not lower, at some point during this bull market. We can swap just over 1,000 ounces of silver for a brand new home. Not a bad deal, especially for those who maybe are interested in purchasing rental real estate. I prefer real estate investment trusts as opposed to physical real estate, just because I'm not handy at all, and I don't like headaches and dealing with tenants and broken appliances, all this kind of stuff. So I just prefer real estate investment trusts where I can collect a really nice dividend from them, have other people manage it, and then I can sell call options around my core positions to produce even more monthly income. So I much prefer REITs, and that's why I look at this PSLV to real estate investment trust ETF, PSLV versus SCHH ratio, and we swapped PSLV for SCHH right here, precisely that peak, came way down, and now this past week, silver outperformed SCHH by 11.5%. If we get back up to this red line, I'm going to swap a little bit more PSLV for some REITs. Same thing with US dividend ETF. Swapped some silver for SCHD up here, and since then, SCHD has outperformed. Well, now it looks like we've seen a bottom right against this support, and if we get back up to these levels around this 2.1 ratio, well, that's why I'm going to swap a little more PSLV for SCHD. One more ratio chart, then we'll get on to actual charts of price charts of our focus sectors. But one I've been watching very closely is uranium versus gold, and I think uranium is bottoming here relative to gold. In other words, I think uranium is going to begin to outperform gold by a pretty wide margin. I own both, so if I'm wrong, that's okay. I've got plenty of silver, plenty of gold if I'm wrong, but I'm really looking to accumulate more uranium than I am precious metal stocks right now. Here's the 200-day moving average on this ratio, just beginning to flatten out, and then soon looks like it wants to begin sloping upwards. So I'm looking for uranium to outperform gold by a wide margin. All right, gold. We call this baby step 1, right? When we broke out above this green downtrend line, well, then we got above the 50-day moving average, so that's baby step 2, but we're still below this flat 200-day moving average. So getting above that 200-day is the next key level. We get back above a rising 200-day moving average with the 50, and the 50 gets back above the 200. We're in an uptrend by any definition, and that's when those algorithms and institutions and retail and momentum chasers can really pile back into gold. So I think gold came back on a lot of people's radar last week. They maybe kind of forgotten about it, more generalists. But we get above that 200-day, that's the next key hurdle. So looking good in gold. Gold miners are back above their 200-day. They can see on this RSI, it's pretty extreme overbought on the daily. Anything above 70 is considered extreme overbought. We're at 70.39. So often when you punch above that 70 level on RSI, it tends to go a little bit more, but then it precedes a kind of a shakeout, a sharp move down. Not to make new lows or anything, but you often reset that RSI a little bit lower. So I wouldn't be surprised to see maybe a little bit higher here and then consolidate right along that 200-day moving average. That would be ideal. I would love to see that. In fact, not that the market cares what I hope happens, but I was talking about retracing half of the gain. So we went from about what's called 69.74. So just call it 70 for easy math, and the high on Friday was 90. So we went from 70 to 90. So it's that $20 move, right? So what's half of 20? 10. So if we pull back to 80, that would be a good spot. That would be a retrace of half of this last week's move. So anything around 80, I think would be a spot where I'm going to be personally looking to accumulate a little bit more GDX. Let's see here, Royal Gold. Royal Gold did not get above 200-day, although it's right there. I mean, it's kind of hard to see that candle because it's right on the 200-day. So the 200-day is 229.56, and we closed at, let's see here, 229.92. So we are a few pennies above the 200-day. It's really hard to see that right there. Royal Gold, like I said, I want to own 10 more shares. I've got 90 of my desired 100 share allocation, so I want to get 10 more shares of Royal Gold. Let's switch gears, talk about silver. Silver's kind of lagging a little bit, which is typical, right? When we had this big move here, what happened? Gold led the way, right? Physical gold. Then the senior gold miners played catch up, and then finally silver played rapid catch up. That a slingshot move, and then it surpassed gold. It began to outperform gold by a wide margin. So I wouldn't be surprised to see something similar happen here, where gold kind of breaks out first, and the gold miners, and then silver kind of plays rapid catch up. Now remember, before the next big deflationary impulse, I'm not sure, that we get. I'm going to be looking to take profits up here, up near 121, if and when we get there, before the next big deflationary impulse. That doesn't mean you can't shoot higher. I don't rule out kind of overshoot up towards 150. And if that happens, let's just say we over the next 12 to 18 months we run up towards 150. I took profits here 120. Yeah, I missed the last $30, but if I'm right, we get a big deflationary impulse, and everything kind of crashes, quote unquote. I hate to use that kind of dramatic language, but if something like that happens, well, I'll have plenty of cash to scoop up back down here. So I just want to kind of give you my long-term roadmap. It's one of the emphasis points of this week. SILJ above the 200-day moving average and getting pretty overbought, not above that 70 level. So that kind of lends to the weight of evidence that we get a little bit more upside and then kind of pull back a little bit. It's kind of my operating baseline assumption if I were to give a forecast. Weekly precious metals just been on a tear. So we bottomed at 101 and got as high as 136. So at the $35 move, what's half of 35? 1750. So if we pull back another 1750 from here, so it's at about 109, 108, somewhere in there. That would be an ideal spot to accumulate a little bit more weekly precious metals, and that's exactly what I plan to do. All right, let's switch gears, talk about uranium. We had been highlighting the huge discount to net asset value on the Sprott Physical Uranium Trust, saying, hey, whenever we get north of about more than a 10% discount to its net asset value, that tends to mark lows in the sector. We got as high as a 12% discount, and I tried to kind of pound the table on that and really emphasize that point. Well, that discount has shrunk to 7%. It's still elevated, but that reinforces that kind of that data point. Whenever we get north of 10, let's really take note of that going forward. Had a really nice day on Thursday while the rest of the sector was down, and then the rest of the sector was up on Friday, but Sprott Physical Uranium Trust was down. You can see this red candle. I do expect for this 200-day moving average to be cleared in short order and for this uptrend to resume in Sprott Physical Uranium Trust. So let's take one more look at this historical premium of market price to its net asset value, and I put these red and green lines on here. So this green line represents a 10% discount to net asset value, and you can see whenever you get below there, I mean, it tends to be short-lived. There's little spikes, but what happens? It mean reverts after that. So we got below that 10% level just recently, and we kind of emphasize that, and now it's quickly mean reverting. Now conversely, if you can get to a 10% premium to its net asset value, that's effectively gives you the opportunity to sell uranium at a 10% premium to the actual price by selling shares of SPUT. So you can see that's pretty short-lived too. We're nowhere near there now, but I'm just kind of planting that seed for the future because I think we're going to get back above that 10% level at some point, and that'll be an opportunity to take profits. URNM, this chart looks very similar to like a lot of the precious metal stocks, but it hasn't broken out yet. Remember we were talking about like baby step 1 in silver and gold getting above the downtrend line in the 50 and the 200. Well, we saw it cleared the primary downtrend line in URNM, which represents kind of the uranium sector. It's a pure play uranium mining ETF with about 15% exposure to physical metal. So this really is a good proxy for the whole uranium sector, and haven't broken above that downtrend line yet. I expect that to happen, just like silver and gold. Got to clear that in the 200-day. So to me, uranium is the best value proposition. Speaking of value proposition, we did add to UEC down here, and I made really good money selling puts and selling calls down around in here as it was kind of banging around below $10. Had a nice move off this low, but I'm kind of kicking myself for not adding more, to be honest. I mean, that just to me that's kind of one of those opportunities that doesn't come along very often. I mean, I'm grateful we added, but to be able to buy a quality company like this below $10, I wish I added more. So I'm hoping I get that opportunity to add a little bit more below 10. I should put that in the key takeaways over here. So you can kind of add that to the list. I wish I added a little bit more UEC. Cameco, nice bounce off the lows. If we retrace about half of that, so we get down to about high 80s, I'm going to add a little bit more Cameco. And I'll probably sell more puts as well. So remember, when you sell a put option, you get paid for obligating yourself to buy shares at a lower price. So you can see how this is an awesome strategy to accumulate stocks, to get paid. You literally get paid to buy stocks you want to own anyway. Why more people don't do this, I don't know. I mean, I don't mean to sound like in a condescending way because I wasn't so focused on this strategy. I've known about it for a long time, but now that I'm doing it like every day. I'm making a couple $100 every day, and it's in a way that's very low risk. We have a 90% accuracy rate. So we did sell a cash secured put here on this date, and I put that out to a whole silver charge community. So we collected $303 for saying, hey, you know what, it's already oversold, but if it comes down to 75, I'll buy 100 shares. But you got to pay me for obligating myself to do that. So I collected $300. So we since closed that trade out, so we're able to buy back for pennies on the dollar. So now if it comes back down here again, I'm going to add shares and I'm going to sell another put. And a strategy I want to kind of share with you, real simple, is let's say there's an asset you want to own and you're not sure if you should buy shares right now. Well, something you can consider doing is like we sold that put down here and said, hey, I'll buy if it drops lower. Collected $300. We can take that $300 that you get immediately and turn around and buy shares. So it's a way to buy some shares right now with the money you just collected, and then potentially acquire even more shares down lower. I've even been thinking about doing that with accumulating physical metals. Like I have no interest in owning SLV when I can choose PSLV, and same thing with GLD when I can choose PHYS or even better physical metal. But SLV and GLD make good trading vehicles because they're liquid. They have a deep liquid market. So my point is, how cool of an accumulation strategy would it be to sell out of the money put options on, say, SLV every month? You just sell some put options and you structure it in a way that you're 90% of the time you're not going to get assigned the shares. You're not going to own SLV, but you collect a few $100 every month, and then you take that few $100 and buy physical metal with it. It's like you're getting paid to buy physical metal. Pretty interesting strategy. Just there's a lot you can do with options, and it doesn't have to be complicated. Oklo just had gotten beaten down. It got to below 40, and we did add down here, but obviously I wish we added more. I mean, because it really looks like the lows ran had a 14.7% move following earnings on Friday. Still has some technical damage to overcome here. So if we get down below around 40, I'm probably going to add a few shares to Oklo. This is a high risk, high potential reward trade for me. If the technology doesn't work out, if they never become profitable, well, this is the kind of stock that could also go to zero. So I want to mention that. But if it works out, which I obviously think it will, or else I wouldn't buy it. I think it's going to exceed this $193 level that it got to last year. So even just getting back to there from 40 to call it 200 would be a 5x move just to get back to where it was. Switch gears here. Talk about energy. By the way, I do want to own some more Constellation too. Let's talk about oil. I think to me, this makes a lot of sense. It's just accumulating down here and turning profits up here rather than get into the preaching game. And that's worked out really well. Like I said, there's very smart people who make a case for 200 plus barrel oil, which, to me, it's almost too easy though to understand. Like, the market is rarely that easy. I mean, if it were as simple as, hey, Strait of Hormuz is closed, obviously oil's going to go higher. We're all going to get rich off of that. I mean, I hate to talk about like things like that with when people are dying and war. I hate war, but it's too simple in my mind, and it's rarely that easy. And I think a lot of retail traders kind of maybe got burnt by maybe going taking on excessive position sizes with leverage, thinking oil's definitely it's 100% going to go to 200 plus, like it has to. The Strait of Hormuz was closed. That's enough on that. And it might go to 200. But I don't think it's as certain as many people think. And I think over the long term, it will, based on normal market supply and demand fundamentals, not so much because of geopolitical events. Although I could be wrong. I'm no oil expert. We've been selling a lot of put options on Exxon and Chevron when it gets down here, and we sell call options when it gets up here. So we had sold calls, remember, on Chevron a couple weeks ago when it was way up here, and when everything was heating up again, the president's putting out tweets that they're going to bomb them into oblivion, and cursing about how they're going to just ruin the country and bomb them into oblivion. Well, that would seem crazy. Like, why would you sell call options up here? Well, remember, bullish headlines are often loudest at intermediate peaks. So we collected a few $100 by selling call options on Chevron. We did the same thing with XLE, and we're now able to buy those back for pennies on the dollar, and then we'll do it again. If we come back down here, I'll sell puts. If we come up here, I'm going to sell calls, and just keep that income generating as this volatile asset moves back and forth. All right, guys, I'm going to go ahead and wrap it up here. Hopefully you found this video helpful. I'll be in touch throughout the week, and God bless you. Thank you so much for being here. Talk to you soon.